Welcome to Finance, Accounting and Banking. Changes in capital. Capital is what the owners of a business can claim from the business. It is also referred to as owner's claim or owner's equity. Capital does not remain static but changes over time due to the following: 1. Drawings. 2. Investments. 3. Losses. And 4. Profit. We start with drawings. Drawings refer to cash or other items taken from the business by the owner for private use. Drawings reduce a firm's or a business capital or wealth. An illustration or example. On 1st of January 2002, Odhiambo had capital equivalent to 100,000, 60,000 in cash, and 40,000 in stock. On 2nd January, he took cash from the business to pay his child's school fees. So, what is the effect of this transaction done on 2nd of January? The asset cash reduced by 20,000 from 60,000 to 40,000, and capital or the worth of the business reduced from 100,000 to 80,000. So, this is how a balance sheet will look like at the start and then when the transaction takes place. So, the first one, Odhiambo balance sheet as at 1st January. The stock was 40,000 and cash 60,000. And we have said that that is the capital the business had as the year started. So on 2nd, Odhiambo took cash equivalent to 20,000 from the business to pay school fees. So the capital will reduce by 20,000 out of those drawings to 80,000. And on this side of assets, the stock still remains as 40,000, but cash will be 40,000 out of the drawings that were made from the total cash that was 60,000. We look at additional investments. This refers to cash or other items brought into the business for use, and they increase the worth of the business or the wealth of the business. A business therefore takes ownership of the cash or items brought from outside. So investments basically increase a firm's or a business capital. So an illustration. If Odhiambo sold his personal shamba on 4th of January for 50,000 and invested the cash into the business, then it means that cash will increase by 50,000. And asset cash will increase by 50,000. So capital will increase by 50,000 and cash will increase by 50,000 in line with our example. So another transaction, on 5th of January, he brought his personal furniture worth 12,000 into the business. So the furniture will increase, which means that assets will increase. And capital will also increase by the same amount. So this is what the balance sheet will look like on 5th of January. So the stock 30,000. Cash will have increased to 90,000. Furniture, 12,000. And then capital will have increased by 62,000. That is the 50,000 that was brought in and 12,000 that was also brought in. And the balance sheet will have a total or totals equivalent to 132,000. Profit refers to gains obtained after selling goods or services at a higher price than that which they were bought at. This is the main idea, objective, or purpose of a person starting or running a business. So profits increase a firm's capital. An illustration: on 5th of June 2020, goods bought by John Enterprise at 20,000 shillings were sold at 25,000 shillings in cash. So the business initially had capital worth 20,000 on 1st of June. So that transaction will have this effect. Capital will have increased by 5,000 from 20,000. And cash will have increased by 25,000, while stock will reduce by 20,000 because we'll have sold all the stock worth 20,000. And then we will have brought in cash, or will receive cash for the business equivalent to 25,000. So, on 1st of June, this is what was in the business. Stock worth 20,000. So, the capital of the business was 20,000. So, on 5th, John Enterprises received cash worth 25,000 out of selling this stock. The stock was worth 20,000. It has been sold at 25,000 cash. So the capital that we had will have increased by 5,000 due to additional money realized after selling the stock. And that additional money is what we are calling the net profit. Losses refers to reduction in value suffered after selling goods or services at a price lower than that which they were bought at. Businesses would like to avoid loss at all costs. You cannot enjoy running a business where you buy items at a higher price than you sell them. You will realize nothing except losses. You will have lost or decreased or reduced a firm's capital. An example: on 5th June 2020, goods bought by John Enterprise at 20,000 were sold at 15,000 cash. So the business initially had capital worth 20,000 on 1st of June. So the effect is this, that capital decreased by 5,000 from 20,000 to 15,000. And asset cash realized was 15,000, with asset stock reducing by 20,000. Remember, stock was worth 20,000. It has been sold, all of it. So nothing remains, but we have received 15,000, meaning that we have suffered a loss of 5,000. So the balance sheet as at 1st June, the stock worth 20,000, therefore capital is 20,000. On 5th, the business realizes a loss because the stock that was worth 20,000 was sold at 15,000. So capital will reduce by 5,000 So at the end of it, we will have the balance sheet with balances equivalent to 15,000. Thank you. Subscribe and like my channel at Eddie Karis. Thank you. Edward Kariuki Madenge, Kariuki Eddie 2010 @gmail.com.